Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Kraken Robotics Inc., ticker KRKNF. We are dissecting the investment case for a highly specialized Canadian-based marine technology firm, and this company has positioned itself right at the absolute forefront of two of the fastest-growing and, frankly, most geopolitically charged sectors in the world.
That's right. We're talking about autonomous systems and advanced subsea warfare.
Exactly. Kraken sells the foundational components, the proprietary sensors, the software, the power systems that really enable the next generation of deep-sea unmanned vehicles.
And the timing for this deep dive is perfect. We have fresh Q2 2025 financials to look at.
We have huge accelerated defense order flow.
And on the other side of the coin, we have the execution risk of a massive manufacturing scale-up that is happening, well, right now.
So for anyone interested in the future of defense technology or just the sheer engineering required to dominate the deep ocean, you're going to want to listen to this.
It is, I think, the definition of a high-risk, high-reward deep dive. And to frame this whole discussion for you, the listener, right out of the gate, here's our thesis statement.
Let's hear it.
Kraken is an AI-driven subsea enabler, betting its SeaPower dual moat and accelerated defense orders of $45 million year-to-date will drive it toward the $135 million revenue guidance. But the thesis is heavily exposed to extreme customer concentration, mainly with Anduril, and the binary risk of its $200 million battery production scale-up.
So our mission today is really to assess whether that growth premium the market is giving this stock is justified.
Exactly. Is it justified by Kraken's unique technology and its critical market position? Or are the risks, the concentration and the execution hurdles, are they simply too immense to overcome?
Okay, let's start with the fundamental scorecard then. The Q2 2025 financial performance. We need to understand the health of the business model before we get into all the hype.
Right. So Kraken reported consolidated revenue of $26.39 million for the quarter.
On the surface, that looks solid. I mean, it's a respectable increase of 13% year over year compared to $22.76 million in Q2 of 2024.
It is. But, and this is an important but, if we pull back and look at the year-to-date figures, the overall revenue for the first 6 months of 2025 actually declined slightly compared to 2024.
A slight dip. So what does that tell us about what's going on under the hood with the sales mix?
That slight decline. It was $42.52 million versus $43.63 million last year. It tells a story about lumpiness. And that's, really common in defense contracting.
Okay.
The revenue stream had a massive mix shift. Specifically, we saw a noticeable 14% decrease in product revenue during Q2.
And why was that?
It was directly linked to the expected completion of these large multi-year projects. Things like the winding down of the Canadian Navy RMDS project, combined with just the timing of their signature CAD-FRUSH synthetic aperture sonar sales.
So these are big, sporadic hardware purchases.
Exactly. When one finishes, there is almost inevitably a revenue valley before the next major contract starts to ramp up. It's a temporary headwind, but it does highlight the structural volatility of relying on hardware sales alone.
And that structural volatility is precisely why the performance of the service segment is so critical and, frankly, so exciting for the bulls in this story.
Oh, absolutely. The service revenue didn't just grow. It exploded.
It really did.
The $9.8 million in service revenue they reported in Q2 demands attention. That's a stunning 180% increase year over year.
Wow, 180%.
No, this isn't just a minor line item anymore. It's becoming a really significant stabilizer for Kraken, helping to offset that product volatility you just mentioned.
So what's fueling that?
It's fueled by two synergistic drivers. First, you have organic growth from high utilization rates of their existing sub-bottom imager assets. They're just keeping those specialized vessels busy.
And the second driver?
Second, and this is crucial, is the contribution from the recent acquisition of 3D at depth. Kraken closed that deal on April 1st, 2025 for about $17 million US.
Which is around $23.52 million.
Right. And that acquisition brought in immediate high-margin service revenue from LiDAR and subsea measurement services. It immediately enhanced their data-as-a-service capabilities and, really accelerated their shift away from being just a hardware vendor.
Now, acquisitions are supposed to boost revenue, but a lot of the time they can drag down profitability, right? Integration costs and all that.
They can.
But here's where the proprietary nature of Kraken's tech really shines through. The gross profit margin improved dramatically despite the acquisition and that shifting revenue mix.
That's the structural advantage Kraken possesses. Their gross profit margin improved to an outstanding 56% in Q2 2025.
56%. Let's put that number in context for you.
Please do. It's a big one. It's a 500 basis point increase from 51% just the year prior. Now think about the aerospace and defense sector average. It typically hovers around, what, 26%?
So Kraken's GPM is more than double the industry benchmark.
More than double. And this margin profile isn't an accident. It's a direct consequence of controlling two distinct proprietary technological niches: the advanced synthetic aperture sonar and their patented pressure-tolerant batteries.
When you have true pricing power over essential components that basically no one else can match.
You capture a disproportionately high amount of the value. That 56% GPM is a massive, massive indicator of their technological moat.
So, okay, we have strong revenue growth, explosive service growth, and best-in-class margins. But if everything looks so healthy, why did Kraken report a C$699,000 net loss in Q2? That's a complete reversal from the $2.61 million in net income they had in Q2 2024. Does that signal a problem?
It's a great question. That net loss is less a sign of operational distress and more a symptom of a company that is prioritizing massive hypergrowth over any short-term profitability.
Investing in growth.
Exactly. The loss was driven by two key factors. The first was that lower product revenue timing, which we already talked about. But the second and more significant factor was the spike in administrative and operating expenses related to integration and expansion.
So costs from the 3D at depth deal?
Yes. And critically, they are investing aggressively to pursue new, larger business opportunities and to expand their sales pipeline globally. This is a tangible investment. Their headcount grew from 262 employees in Q2 2024 to 378 in Q2 2025.
That is rapid hiring.
It is. And that kind of investment impacts the bottom line immediately. But it's the necessary precursor to achieving the revenue guidance they've set. It's a strategic spend for future scale.
And management is certainly signaling confidence in that future scale. Despite the short-term profitability dip, they emphatically reiterated the full-year guidance.
They did. They confirmed the full year 2025 revenue guidance of $120 million to $135 million. Now, this is the number we need to focus on.
Because at the midpoint, that's what, 40% revenue growth year over year?
40%. And given they only hit $42.52 million in the first half, this guidance implies a monumental ramp-up in the second half of 2025.
So they need to generate almost $90 million in the back half of the year.
They do. And this pivot, this expectation of immense growth and execution, brings us directly to the core of the whole investment thesis, the technological moats that justify this premium valuation.
Let's unpack those two moats now, starting with the tech that really put them on the map. Synthetic aperture sonar, or SAS. This is their bread and butter. For someone who might be familiar with traditional sonar, what makes Kraken's SAS systems so fundamentally different?
The difference really lies in overcoming a fundamental physical limitation of traditional acoustics. Traditional side-scan sonar, which has been the standard for decades, is, well, it's relatively simple. It sends out a pulse, and the image resolution is dictated by the physical size of the acoustic array on the vehicle.
So the further the pulse travels, the wider the beam spreads, and the resolution just degrades. It's like trying to take a sharp photo of something far away with a tiny lens.
That's a perfect analogy. You're forced to make a trade-off between speed, or how wide you scan, and detail.
And Kraken's SAS eliminates that trade-off.
It completely eliminates it. They use this intelligent proprietary software and really sophisticated signal processing, what engineers call coherent processing, to essentially mimic the performance of a much, much longer antenna array than the UUV is physically carrying.
So it's synthesizing a massive effective aperture.
Precisely. It's not just a software trick. It's signal processing genius that allows them to maintain a constant high resolution across the entire swath, regardless of the range.
Constant resolution is the key phrase there. What are the specific metrics? How much better is the data quality?
The difference is night and day. Kraken sonar achieves an exceptional resolution of 3 centimeter by 3 centimeter pixels at 80 meters away.
3 by 3 centimeters. That's incredible detail.
It is. It's the kind of detail you need for high-stakes missions like finding sea mines. Now, a leading traditional side-scan system at that same range, you'd be lucky to get about 20 centimeter resolution.
So the difference between seeing a blur, a shapeless shadow on the seabed, and actually identifying an object.
Exactly. You can recognize its profile. You can even see fine details like wires or debris. For defense and for critical infrastructure mapping, that precision is completely non-negotiable.
And beyond just the clarity, you mentioned efficiency. How does this translate into actual cost savings for a client, whether it's a Navy or an offshore energy company?
The efficiency comes from their miniature interferometric SAS, or MINSAs. It achieves a critical operational advantage: dual data collection in a single survey pass.
Okay, what does that mean?
It means in one trip over the seabed, the system simultaneously collects that high-resolution 3-centimeter imagery and a 25-centimeter resolution bathymetric data set, which measures the seabed contours and depths.
And why is that so important?
Because vessel time is the single most expensive component of any survey. By getting two essential, high-quality data products in one pass, Kraken dramatically reduces the amount of time a client's crew and vessel have to spend on location. It cuts operational costs significantly.
So they deliver better data faster, which explains that 56% margin.
It's a huge part of it. The solution isn't just technologically superior, it's economically compelling.
Okay, so if the SAS sensors are the superior eyes of the UUV, then the SeaPower batteries are the relentless heart. And this is arguably the technology that's driving the immediate revenue ramp-up we're seeing.
The SeaPower technologies are the real defense game changer. It directly addresses the primary weakness of almost all deep-sea autonomous vehicles: power and endurance.
How does it work?
It utilizes a proprietary, patented, pressure-tolerant design. This involves a unique polymer or silicon encapsulation process that physically protects the individual battery cells.
And the breakthrough is that this design completely eliminates the need for those heavy, expensive, and complex pressure vessels you usually see.
Right. It gets rid of the heavy pressure housings or the messy oil compensation systems that traditional subsea batteries need to keep from basically collapsing under pressure.
So traditional UUVs are essentially carrying a small submarine just to house their own batteries. It's a huge waste of payload and space.
Precisely. And by shedding all that dead weight, the operational performance metrics just improve dramatically. Kraken's batteries offer up to twice the energy density compared to traditional cells.
And they're lighter, too.
46% less weight per kilowatt hour. For a UUV, this is revolutionary. More energy in a lighter package means the vehicle can carry more sensors, it can travel faster, or, and this is the most important part for long-duration missions, it can operate for substantially longer periods without needing to surface.
Which increases mission effectiveness.
Drastically. And the depth rating on these things, it really speaks volumes about the engineering.
It does. I saw they can withstand pressures up to 660 bar.
Which is the pressure equivalent of operating at 6,000 meters ocean depth.
6,000 meters. That opens up access to the vast majority of the world's ocean floor.
Exactly where global communication cables are, critical pipelines, and where strategic military operations happen. This patented IP gives Kraken a durable market advantage, especially for the new class of extra-large unmanned underwater vehicles, the XLUVs. This is why we say they have no direct competitors in this specific niche.
They're providing the essential fuel for the next generation of subsea warfare.
That's the perfect way to put it.
And that technical superiority in both sensing and power is what's driving this military validation story, which is just dominating the revenue growth right now. Let's talk about the geopolitical context here.
Well, it's the ultimate tailwind, isn't it? Strategic competition in contested waters, whether it's the South China Sea, the Black Sea, or the Arctic. It has made autonomous systems a top priority for every major navy.
Unmanned systems are cheaper, they're disposable, and they keep sailors out of harm's way.
And this strategic shift has given Kraken an anchor client that is just dominating their growth narrative: Anduril Industries.
The Silicon Valley defense tech unicorn.
That's the one. They are Kraken's primary lodestone client, aligning Kraken perfectly with major U.S. defense strategy shifts.
You mentioned the U.S. Navy's initiative, Project 33. We should probably detail that for the listener because it gives the context for why this Anduril relationship is so critical.
Right. Project 33 is a strategic directive by the U.S. Navy. The goal is to rapidly scale up the deployment of robotic and autonomous systems across the U.S. fleet by 2027. It's a recognition that the U.S. needs volume and speed to counter peer adversaries.
And Kraken's technology is essential for that. The SAS for mine countermeasures, the SeaPower batteries for the endurance.
You can't have one without the other. The platforms are just inert objects without the power. And the flow of capital is reflecting just how critical this is.
So let's talk about that capital flow. What are the current orders we're looking at?
The order flow is massive. It's hard to ignore. Kraken secured $45 million year to date in SeaPower battery orders as of April 2025.
$45 million.
And what's remarkable is the concentration. The majority of that came from a single foundational $34 million order, with $31 million of that from a single defense UUV provider.
Which points directly back to Anduril.
It does. Kraken's technology is moving from being a nice-to-have component to an absolute bottleneck component in the global defense supply chain.
And this brings us to what you call the hyperscale upside. The market isn't pricing Kraken on the $45 million they just booked. They're pricing them based on the immense potential tied to Anduril's manufacturing plans.
This is the $100 million question. Kraken's products aren't just theoretically involved. They're embedded into Anduril's flagship platforms. The 3-ton Dive-LD UUV and the larger Ghost Shark XL UUV for the Australian Navy.
And the bull case rests on Anduril's massive expansion in the U.S. Tell us about that factory.
Anduril is building a massive, modular, hyperscale, 150,000 square foot factory in Quonset Point, Rhode Island. The entire goal is to rapidly automate and scale defense manufacturing.
And the capacity target.
It's incredibly ambitious. The facility is expected to be fully operational by late 2025 or early 2026, and it's designed to churn out up to 200 Dive-LD UUVs per year.
200 a year. Okay, let's pause and break down what that means financially for Kraken, because this is where the premium valuation is coming from. How do analysts get to that projection of $100 million a year in incremental revenue?
Well, we have to make certain assumptions based on the disclosed component value. Analysts estimate that the combined value of Kraken's batteries and sensors, the SeaPower packs, the CS systems, the software, sits at around $3 million per unit for a sophisticated UUV like the Dive-LD.
Okay, so if Anduril hits its target of 200 UUVs a year,
and if Kraken maintains its position as the exclusive supplier for those critical components, then simple math suggests a potential $100 million in revenue flowing directly to Kraken every single year.
that one single relationship could almost double Kraken's current revenue run rate.
In the near term, yes. It transforms Kraken from a specialized supplier into a critical high-volume manufacturing partner. It's a total game changer.
And to cement that strategic depth, we also saw a major board appointment recently that signals their intent to embed themselves permanently in the U.S. defense complex.
Absolutely. The appointment of Kristen Robertson to Kraken's board is highly significant.
She's a defense industry heavyweight.
She is. A former executive at RTX and Boeing, and notably, she oversaw the U.S. Navy's flagship Orca XLUV program. Her presence on the board isn't just about general expertise. It signals a deep intent to gain access to the highest levels of U.S. defense procurement and technology strategy.
It's a very explicit move.
It is. It's about reinforcing their position as an indispensable component provider for all future XLUV programs.
Okay, so that transition from a smaller Canadian tech provider to an indispensable supplier for the U.S. defense industry, that demands immense capital. Let's shift our focus to the growth drivers and the financial strategies supporting this ambition.
Capital was the immediate need. And Kraken recently executed a successful public equity offering, which generated aggregate gross proceeds of $115 million.
It's a massive capital injection.
It is. They issued 43,240,000 common shares at $2.66 per share, and we have to address the immediate consequence of that move.
Which is the shareholder dilution. 43 million new shares is significant. What kind of pressure does the $115 million raise put on management?
The pressure is intense, and it's immediate. Kraken's premium valuation is already based on high growth expectations. Now, with this dilution, management is under immense pressure to deliver that promised 40% revenue growth flawlessly to justify it.
They sold a massive chunk of the company to finance growth. That bet has to pay off, and it has to pay off quickly.
It does. But the funds are being strategically deployed. They serve two critical purposes. First, it's an M&A war chest, letting them consider larger accretive acquisitions of the U.S. and Europe.
To become that scalable global prime contractor.
Right. And second, having $115 million strengthens their balance sheet. That is a non-negotiable requirement when you're bidding for these massive multi-year government contracts.
And while the capital funds M&A, the most critical investment, the one tied directly to the thesis's binary risk, is the manufacturing scale-up for the batteries.
That is the single most important execution risk on the balance sheet. Kraken is investing about $10 million into a brand new Subsea power manufacturing facility in Nova Scotia.
And this isn't just a modest expansion.
Not at all. It is a fundamental shift in their operational footprint. The singular objective here is to triple Kraken's current battery production capacity to a staggering potential of almost $200 million annually by late 2025.
That timeline is incredibly aggressive. Scaling a complex, proprietary manufacturing process to see $200 million capacity in less than a year. Let's push back on that. What are the key risks that could derail this?
The risks are manifold. The polymer encapsulation process is highly specialized. Scaling up proprietary manufacturing is difficult anywhere, but doing it on a tight deadline in Nova Scotia where specialized labor can be tight introduces real execution risk.
Equipment delivery, commissioning, hiring.
All of it. And that $200 million capacity target is perfectly aligned to meet the expected volume from Anduril's Rhode Island facility. If any part of Kraken's supply chain or construction is delayed, or if the quality control fails to meet the extremely high standards for defense assets.
The whole financial thesis linked to that $100 million incremental revenue just collapses.
It does. This facility's successful, timely launch is the binary hinge point for the stock's valuation.
So on one side, we have the hardware scale-up, a massive high-stakes manufacturing bet. But on the other, Kraken is innovating its business model to capture recurring revenue, moving up market to offer robotics as a service and data as a service.
That's their Ocean Vision project. And this strategic shift is vital for stabilizing that 56% gross margin and reducing the product volatility we talked about earlier.
So how does the data or data as a service model work?
It's built on a very simple but powerful philosophy. Survey once and repurpose many times. Because Kraken controls the world-class sensors, they can deploy their vehicles to continuously collect environmental data, detailed imagery, you name it, and then license that proprietary data to multiple disparate sectors at the same time.
So the data itself becomes the scalable product. Give us a concrete example.
Okay, take a specific 100-kilometer stretch of seabed. A Navy might license the high-resolution SAS data for mine countermeasures. At the same time, an offshore wind company might license the exact same bathymetric data to find locations for turbine foundations.
And a subsea cable operator.
A subsea cable operator might license the optical data for automated change detection using Kraken software to monitor for tiny seabed erosion changes along their pipeline. It's far more cost-effective than forcing each client to fund their own bespoke campaign.
And it turns volatile product sales into predictable annuity-like revenue.
Exactly. And since the marginal cost of licensing existing data is near zero, it aggressively supports that high gross margin profile.
Let's synthesize the entire investment case now for the final verdict. Looking purely at the upside, the bull case for Kraken is highly compelling.
Without a doubt. They have a first-mover, technologically superior advantage in two critical non-commodity niches. This edge is validated not just by commercial success, but by the massive capital flow driven by global defense needs.
The potential $100 million annual Anduril upside and the structural strength of a 56% gross margin. It provides a clear rationale for the stock's premium valuation.
They are the definition of a specialized enabler in a rapidly expanding sector.
However, the risks are not trivial. They are structural and they are extreme. What should the listener prioritize when considering the downside?
The concentration risk is paramount. Kraken is fundamentally dependent on the success and loyalty of its primary partner, Anduril. The financials confirm this. As of June 30th, 2025, a staggering 80% of Kraken's trade receivables were owed from just two customers.
80% from two customers. So if Anduril were to pivot strategically,
the resulting revenue shock to Kraken would be immediate and catastrophic. This concentration risk demands constant scrutiny from any investor.
And we can't ignore the financial consequences of their rapid growth strategy.
Correct. The company is trading at a premium valuation, with a forward EV sales multiple around 8.74x. That premium assumes flawless execution and sustained 40+% growth.
And the recent $115 million equity raise caused significant stock dilution.
It did. Management must execute the $200 million capacity ramp-up on time to generate the revenue needed to justify that dilution. If they miss the mark, the stock has a long way to fall to adjust for that mispriced execution risk.
Finally, what about external geopolitical risks from their supply chain structure?
That's a critical external factor. Kraken is a Canadian firm, but its highly proprietary batteries are currently made in Germany. This international supply chain exposes them to a significant binary risk regarding U.S. tariffs and protectionism.
Any sudden tariffs could increase costs and squeeze those margins.
Or worse, it could incentivize a major American client like Anduril to actively build competing domestic battery production to ensure supply security. That international footprint, while beneficial right now, introduces a real element of geopolitical risk.
So if we look at the entire picture, the technological supremacy versus the execution and concentration risks, what is the final summary judgment for the investor?
This is unequivocally a high-risk, high-reward investment that is a direct bet on execution capacity. The market is pricing in the success of the $200 million capacity expansion in Nova Scotia and that perpetual exclusive relationship with Anduril.
So if Kraken succeeds in scaling, manufacturing, and maintaining that anchor client,
The projected $100 million incremental revenue justifies and probably exceeds the current premium valuation. But if they fail to hit the production volumes or if that concentration risk manifests, the consequences will be immediate and severe.
so this stock is a pure bet on management's ability to execute.
An aggressive, multifaceted growth strategy against immense competitive and operational pressures. That's the bet.
That sets a very clear framework. And to leave you with one final provocative thought that ties this proprietary tech back to the big picture. Beyond the financial metrics, consider the broader strategic value of the pressure-tolerant battery technology. If major global powers are shifting their strategic assets toward unmanned underwater vehicles for critical missions, the company that provides the essential proprietary power source that enables those missions is not just a parts supplier. They are selling the indispensable fuel for the next generation of subsea warfare. That position of enablement is what Kraken is betting its entire future on.
Risks defined. Portfolio protected.